Talking about 1031 exchanges in this segment of Dollars and Cents. My name, of course, Joel Garris. Nelson Financial Planning is where we spend Monday through Friday. But on Sunday mornings, we spend it behind a microphone, coming out to you on a variety of stations throughout Central Florida. Good morning, Kristen Cayley. How are you?
I'm doing good. How are you?
I am fantastic. Kristen, as our listening audience knows, is not just one of our fellow certified financial fiduciaries, but she also happens to be a CPA, does a lot of tax work for our clients at the office. And I guess one of the things that we're seeing a little bit more conversation about is this thing called 1031 exchanges.
Mm-hmm. Yeah, we've gotten quite a few calls about them, just people inquiring, thinking it might be a good idea. So we thought we'd bring it up this week and just, let everybody know.
There's a lot to know on it. It's going to be hard to cover in a simple radio show, but hopefully we'll hit the highlights for our listening audience. So, describe for us what exactly is that 1031 exchange.
So a 1031 exchange allows you to defer capital gain taxes on a sale. So we most commonly see this with rental properties or investment properties, houses, most likely. It used to be for valuables, personal property, but the Tax Cuts and Jobs Act kind of removed that as a possibility.
Very hard to sort of track that. At least when you sell a property, there's always sort of a deed or recording, if you will, of what that property sold for, but very hard to track that down with a vase or a painting or something like that.
Exactly. Yeah, so essentially you just take all of your proceeds, your gain proceeds, and reinvest it into another sort of property, a like-kind property.
Okay, so that makes sense. So there's certainly some things to note up front when you're thinking about a 1031 exchange in terms of the specifics. It's not like you can just sell the property, grab the cash, sit on it, and then, oh, that property looks nice, I'll just go and buy that property. So what are some of the specifics that's involved there?
Mm-hmm. So you're going to need to engage a qualified intermediary, which is basically a specific 1031 agent. And that's really important because the proceeds have to go directly to this qualified intermediary agent. It cannot hit your hands.
So it's in essence that agent serves like an escrow agent, for lack of a better description on it, because they'll hold the money. And then so when you identify the next property, then they would be the ones to send out the money to purchase that property.
Right.
Okay, so then, and I guess it gets, there's some costs probably associated, and then there's also some reporting that needs to be done on those types of things.
Right. So the intermediary sometimes costs a couple $1,000s depending on the transaction and the agent. And then on top of that, you'll probably need to engage a CPA because this 1031 exchange has to be re-reported on your tax return. It's a specific form, it takes a lot of calculations, and it needs to be reported correctly, so probably going to have some CPA fees in there too.
Well, and the important thing too is if you're doing it, you're really carrying forward past transactions. And so you're certainly going to want not just an accurate record of those, but an accurate reporting of those to the IRS along the way. Because I was actually having a conversation with somebody here a couple of weeks ago, and they're like, "Oh, I'm thinking about maybe selling the property," and then they happened to mention, "Oh, it was on a 1031 exchange." But the 1031 exchange was actually a carryover from a prior 1031 exchange. Mm-hmm. So their basis was like really, really low on that. And that's one of those things that's why you have to kind of report and keep track of those records along the way. So what are some of those mechanics, if you will, on that 1031?
Mm-hmm. So 3 general rules. This replacement property, so the property that you're exchanging it for, should be of equal or greater value. It could be of lesser, but it generally should be of greater value. The replacement property must be identified within 45 days of the sale of your prior property.
So that's a pretty short window.
Mm-hmm. And then the last rule is that the replacement property must be purchased within 180 days of the sale.
Okay, so that's the 6-month rule. You've got to close on it within 6 months in order for it to be valid. Now, there's also an issue, and I think they've sort of tightened the rules a little bit on this about the nature of the property. It used to be a little bit more leeway in terms of what actually like meant for a like kind of exchange, but I guess they've tightened that a little bit.
Right, right. So it's either got to be investment property or business sort of income producing property, like a rental or commercial type of property.
Yeah, and so you've got to kind of also, when you're looking for that next property, you got to find something that is similar. You can't sell a duplex over on the beach and like kind it to a warehouse downtown or something like that. I mean that's part of the issue. So you got an example. Just kind of walk us through what an example of how this might play out.
All right, so let's just say I hold a rental property worth $1 million. And I paid $250,000 for it years ago. So I paid off my mortgage, don't owe any debt on it. So my hypothetical gain on this sale would be $750,000.
All right, so you did pretty well, and real estate is a hot commodity here in Florida these days.
Yep. So that would put me in the 20% capital gains bracket. But remember, I mentioned this was a rental, so there's some depreciation recapture in there. So let's just say my tax comes out to about $175,000. So pretty hefty tax bill there.
Yep.
So I decided to do a 1031 exchange. First, I need to engage a qualified intermediary, and then I can move forward with the sale of my rental property. So 100% of my gain, which was that $750,000, would be excluded. It would go directly to that qualified intermediary while I look for another substitute or exchange property.
I don't get to use the money in the interim. It has to sit with it. What's interesting about that is you really need to kind of, before you start this process, you really probably need to secure that qualified intermediary before you're starting to kind of market the property itself.
Right. So let's say I find a property that I want to exchange it for that's worth $1.5 million. So clearly greater value. And I purchase it within that 180-day window. So I can defer all of my $750,000 gain and that tax bill, the $175,000 tax bill.
So that's good. So then that way I didn't have to pay it, but I really am kind of kicking the can down the road. I mean, it's not like it's just disappears. It's a tax. The 1031 exchange is a tax deferral mechanism, if you will.
Right. So eventually when I sell this $1.5 million property, I'll have to recognize the taxes at that point. Or the only way to get around that is if you leave it to your heirs. You mean
die?
Down.
If
Yes.
I die, I can avoid the taxes.
If you never intend to profit from the proceeds, then
Death and taxes, okay? But you've identified a way how death allows me to avoid taxes. So that's that's not good. I don't like that option at all. But the big assumption there is that the step up in basis is still around. That was one of the many proposals that was on the table last fall that they were looking at eliminating. So that's a big one. This is another good example of where you don't think that really matters, and if they change that part of the tax code, it's probably not going to affect that many people. But it's a great example of where it certainly would. So what happens if the value of the next property is less? How do you do that if you don't want to necessarily put all of that money towards the next property?
Right. So let's go back to my example. So say my property that was worth $1 million, I want to exchange it for a property that's worth $800,000.
Okay.
So then I would have to recognize capital gain on the differential. So the $1 million less the $800,000, so about $200,000. So of my $750,000 gain that I had from before, I'd have to pay taxes on $200,000 of it, and I can defer the remaining $550,000.
Okay, so there's a way to kind of prorate it, prorata it, things like that. All right. So then I guess this is really a technique that we see a lot with real estate investors, because it's certainly a valuable item for them.
Right. So let's just go back to my example again. So my gain proceeds of $750,000. If I reinvest that into a property of greater value, that could be a 20% down payment on a $3.75 million property.
The notion of using leverage, particularly with your 1031 exchange gain, That's an interesting point, because then if I'm a real estate investor, then I really can try and utilize that and maximize out my overall picture. So that is interesting. So we're going to slide to a break. When we come back from the break, we're going to kind of recap this 1031 exchange conversation for our listeners. And then we're going to shift to the 5 do's and the 5 don'ts for your taxes for this year. All that coming up next here on Dollars and Cents. We're talking about the do's and don'ts, the 5 do's, the 5 don'ts for this tax season with our fellow certified financial fiduciary at Nelson Financial Planning. Kristen Cayley also happens to be a CPA as well. So we rolled through 4 of the 5 do's. So let's just recap those 4.
Yep, so the first one, track down your stimulus check. Second, track down your advanced child tax credit payments. Third, total up your IRA contributions. Fourth, total up your HSA contributions. And then the last one here is going to be claim your $300 or $600 charitable contribution.
That's a big one. I mean, with the change to a much higher standard deduction, a lot of people are finding that they're not able to directly deduct their charitable contributions like they used to in the past. That came back a couple of years ago, allowing people to also include an additional charitable contribution deduction on their tax return to sort of further boost up that standard deduction. What are the limitations on that?
So it needs to be for cash donations only.
Okay, so it can't be my trip to Goodwill. It's
Right.
got to be me writing a check, and it's got to be cash.
Right. And it's going to be $300 for single filers and $600 for married filers.
Okay, so those are the do's, if you will, for this tax season. Here come the don'ts. So what's first on the list? This one's not going to make many people happy. But what's first on the list of the don'ts for this tax season?
Don't expect your refund anytime soon.
Oh man, that stinks. Why is that?
So many forms have not been finalized with the IRS, meaning your tax provider or software cannot even file your taxes yet. The forms can't be accepted by the IRS. So even if you've finished your tax return, it may not be filed for another week or two. And then on top of that, the IRS is still processing about 24 million returns from last year.
Wow. I still, by the way, just so we're keeping score, I still do not have my refund. So I'm one of those 24 million, and I want my money. So I hope the IRS is listening.
This is just an unprecedented number, so it's going to be an interesting tax season, and we really think that refunds are going to be delayed because of it.
Well, and again, you still got the 2 confusing factors that generated much of the problem last year. Well, now you have 2. Last year you only had one being the stimulus, and then the other now that's added into that is that child tax credit. Mm-hmm. So, all right. Well, what else you got? What's the next on this list of the don'ts for the tax season?
Don't try to call the IRS.
Okay. What's the numbers on that one look like anyway? How bad is it if I call them?
So from what I've read, the IRS workforce has the capacity to answer about 32 million calls a year.
Okay.
But last year they could not handle all of the 250 million calls that came in and just went unanswered.
So let me get these numbers straight. So the IRS got 250 million calls last year, and they only had the capability of answering like 32 million. Mm-hmm. Wow. Okay. So yeah, that would be a don't. Don't bother to call the IRS. What if I do need to correspond though? Is there another option? Is there a better option? What can I do at the end of the day?
So IRS local offices are beginning to open back up with people physically coming into the office.
Okay.
So it might be a good idea just to look up those local numbers and maybe try to contact them.
Okay.
Better chance than calling the 800 number.
Sure. Than the 800. That is interesting. I hadn't kind of thought, but I guess a lot of those offices, really are starting to kind of finally reopen after a couple of years of being closed. That's just amazing when you think about it. And then I suppose they could also go online and kind of try that. What's that process like?
So similar with what we mentioned before with checking your stimulus check amount and your child tax credit, you can create an account with the IRS. And it'll let you know certain things like if you have an outstanding liability, things like that. They might be able to answer some of your general questions just by looking at that website.
Okay, all right. So that's good at least. All right. Next on the bad news list, the don't list.
So there were certain COVID-specific tax breaks that were only available for 2020. So two in particular that you should not expect to see on your tax return this year. The first one is that unemployment is fully taxable again. So last year there was a non-taxable portion, which was $10,200 per person. So it would have been $20,400 for married filers.
Pretty significant.
So that exclusion is no longer
that
in
one's
place.
gone. All right, you're gonna have to go back to the normal rules of paying tax on the unemployment. Yeah.
Right.
Yeah.
And then the next one is the premium tax credit repayment requirement is back in place. So
okay.
last year it was fully suspended. So if you had any sort of repayment, it was just forgiven and there was no repayment provision. But this year it's back in place, but it is limited. It's limited to 8.5% of your income.
So for that, it's like when I go on the exchange and I get health insurance and I get an advance. It is an advance tax credit that you're getting when you do that, and then you have to chew it up on the tax return. If you bust over the income limit, then you have to like pay a huge chunk back. They waived all of that in 2020. 2021, it's coming back, but not quite as draconian. The most you're going to pay is 8.5% of AGI.
Right.
Okay. All right. And that actually is the rule for 2022 as well. So 2021 and 2022 is that 8.5% rule. So, all right. So what's next?
Don't file your taxes unless you have all your tax documents.
That's probably some good advice. Yes, because if you think that they are behind on processing returns, they're probably even further behind on processing amendments. So that's really important to just wait, make sure you've got everything, because some of them don't come out as early as we think.
Right. So certain 1099 forms may have been distributed to you, this week, so they might not have even gotten to you yet. Form K1, sometimes they have deadlines of March 15th, March 30th, so those might take another month to get to you.
Okay. All right. So those are still coming. And then lastly, what's on my don't list for tax season this year?
Don't forget the deadlines.
That's probably good advice, but that's an important piece because
this is the first time in 2 years we've actually had the regular deadlines. So it's Monday, April 18th for individuals and Tuesday, March 15th for businesses.
Yeah, I mean, it's hard to believe. I mean, the past two tax seasons, the deadline is really was extended. I think in 2020 when they kicked that all the way, that was year one of COVID. So they kicked it all the way to like June 15th, if I recall correctly. And then last year as well, they kicked it to like May 15th or so. So it gave it at least an extra month. But this year, no conversation about that.
Not that we've seen so far.
Yeah, so not April 15th because it falls on a Friday, I think, or it's Good Friday maybe is so the date is that Monday, April 18th. So that's some interesting stuff. So to recap, what are our 5 don'ts for this tax season?
Yeah, so don't expect your refund anytime soon. Do not try to call the IRS. Don't expect those certain COVID provisions on your 2020 tax, or that you saw on your 2020 tax return on your 2021 tax return. Don't file unless you have all your tax documents, and don't forget the deadlines.
Good advice from our fellow certified financial fiduciary and CPA, Kristen Cayley at Nelson Financial Planning. We covered a lot of territory. We ran out of time, did not talk about that top 10 list by the FBI of the scams that seniors need to be aware of online. We'll cover that next week on the program. We thank you all for listening. Thanks for joining us, Kristen.
Yes, thanks for having me, Joel.
With that, have a great Sunday. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning.